What is up, guys? It's Saturday morning here, 8:30, end August, and I've got another financial model. I did one last week, or maybe 2 weeks ago, and now we got the second one. Now, this one is, I'm putting it as probably the best I've ever done. And it was built for a jewelry shop, but it really could be used for a wide range of retail businesses in general. So, and there's lots of retail businesses. But in the context of a jewelry shop, we're going to go through this. So again, I've really been working on my formatting and making these spreadsheets really clear to use for the user. So we've got our index tab, which is describing what is on each tab of the spreadsheet. We've got our instructions, so this you're going to have to read through in order to know how to start using the model. And now we have our first summary page, which is the overview. I've been experimenting with some 3D charts. I thought that looked pretty cool. So, I mean, this is just a general high-level financial summary. Revenue, cost of goods sold, gross profit, fixed and other costs, EBITDA, and we've got, gross profit margin. Then there's also some like one-time project costs and debt service, if any, and then our annual cash flow and cash position. Now, if we go down a little bit here, we have annual sales count by category. So here's all the different categories. We've got hair and head, neck, arms, hands, body, feet, special function components. So those are all the different types, and then within those there's going to be even more of a breakdown when we get to the annual and monthly pro formas. But these are the high level categories, and here's your annual unit sales of each one in years, 2018 through 2022. Which, if I didn't mention, this is a 5-year model. Then you get your total unit sales by year, and a nice visual over here again with the cylinders. Then we've got the same thing, but this is revenue, and I added percentages down here too. So you can see the percentage of each category type. So you can see head and ornaments made up 15% of the total sales of 2018, and etc. as you go. And here's the dollar amounts, and then the revenue. Then we also have annual revenue by pricing tier. And the pricing tier is, it allows you, for example, in a jewelry shop, you might have three main types of pricing: a lower price, a mid price, and a higher price. The low could be, cubic zirconium. The mid could be, I don't know, gold, silver, and the high would be, stuff that's has more diamond and platinum. But it was important to denote three different pricing levels for all the different categories, which we'll see going further. And then here again we have annual revenue by pricing tier with the cylinders. So this is the high level summary, first overview that you're going to see. And you will define a couple model drivers here. So we've got the start month, which you're just going to put the very first day of the year that you're planning on starting the business. Even if you're not going to start it on that January 1st, you'd put January 1st here. You'll have functionality based on the date that's put in here to choose the month that each revenue stream starts. Then we've got sensitivity analysis. So this is what this is a little bit harder to do because you have to build dynamic assumptions. So you have a base place where you put the base, and then you've got sensitivities in a different place, and the model actually has to drive off of the secondary sensitivity tab. And I'll show you how that works here. So let's say I have low here, and you see everything just changed. So if I put low, what that's doing is you'll define the base in the revenue assumptions. This is all your base. So you can change all the start months, the average sale price of each type of category, low, mid, high, the unit sales each year of each category, and then the percent that of each year that's low, mid, and high. So this is saying 40% of these 20 units per month are low sales. 50% of the 20 units are mid, and the 10% are high in year one for Sarpec, which is it's a type of head ornament. So, in what this is kind of difficult, but it's the only way to really concisely build an assumption sheet. Is this is allowing you to put in what your monthly sales are by year. So in year one, you're going to sell 20 earrings a month. Year two, 20 earrings a month, or I could change it to 30, 40, whatever your assumption is for each year, so it can scale and ramp up. And you can also change the percentages over time. And there's some more things that are going on in here that we'll talk about in a minute. But in general, this is where you're going to define the base. And then based on what you put here, and then what you define here, so say I put low, and I'm defining my low as 30% lower. We go all the way over here to the sensitivities. And you can see, look, it's the same sheet I just showed you with revenue, but all of the assumption areas are now lower. So 14. If I were to go back to base, then they would match what's on the actual revenue assumption, which is here. So let's go back to the sensitivity. Now it's all matched. And if we go high, go over here, now everything's higher on the units sold. Now the other so that's the sensitivity for units sold. I also did one for price, so you can put in basically your base prices, and then somebody could come in and say, well, what if you actually can't sell them for that? What if you have to go lower? And lowers negative 30%. You can see now $300 instead of $300, it should be $240 if I do my math right, or $210. Let's see, what's 30% of 300? 90, right? So 90 minus 300 is 210, so that's right. So all these are now lower by 90 or by 30%. And this is what is used to build our monthly and annual pro formas, which we'll get into in a minute. So that's what your sensitivities do and how that functions throughout the model. And you'll write in either, for the low you'll have to put in the minus. For the high you don't have to put anything, just write in, I could just put in 50, 25. It knows it's a positive number, but for negative you have to actually put in the negative first. And we're just going to go back to base on both of these. The other part of the overview is the cash requirements, and we have our startup costs plus inventory. Inventory is going to be defined as a little bit different way. It's simply going to be the first 3 months cost of goods sold, because obviously you're going to have to pay for inventory before you sell it, because this is not like any kind of drop shipping. You're actually buying inventory. So the first 3 months of inventory are accounted for within the startup costs plus the actual startup costs, which your startup costs will be defined here on the startup cost tab. And you can see here's inventory. And the startup cost total $3 million. I've just put in some numbers in here, random numbers, just to show you how this would work in just a made-up scenario. So, and then we have your cash to cover operating losses. So this is if you're running the business, and you're going month 1, 2, 3, 4. If you run an operating loss, then that's going to be cash requirement, because you got to cover that loss to keep things going. You have to pay for whatever expenses cost in that deficit. Now the thing is, inventory is included in the operating cash flow, obviously, with cost of goods sold. So this number is actually the cost of goods sold number net of the cash flow. So we're actually saying, well, we've already accounted for oh, geez, that's not supposed to be there. I was confused for a second. Okay, so we've already accounted for this $38,000 cost of goods sold for the first 3 months is baked into this leverage cash flow number. So we have to take that out. And then if it's still negative after taking that out, then yes, you still have extra costs that you're going to have to find out how to pay for. So here in this case, it's only $7,000. And then we have the cash flow from the month of financing. That's just saying on the month that you're doing financing here is $750,000. We're offsetting all of this to find the leverage cash flow less the financing. So that if that's negative, that's also included in whatever month the financing happens. So the number's pretty accurate, and it's a pretty good. This total investment needed is a pretty good number based on all your assumptions. So this is saying you need 3.1. You've got financing here. You could put this in manually. Let's say, well, obviously 750,000. I still need either from my own pocket or from an investor 2.4 million. Let's say we get, I don't know, $4 million of financing. Now it says we have a net surplus. And one quick thing I want to show you about this. So if this is not enough and you need 2,403,000, you can see on the monthly tab, the 2,403,000 is right there, the third month. And you know why? Because that's the month you start going positive. And this is you're running cash balance. So this is basically saying the lowest, the biggest cash deficit you have is your cash requirement, which makes sense. If you have if your loan is not going to cover all the cash you need, which in this case it doesn't, and that makes sense. So now, and you can see after this month you're starting to go positive, so obviously there's no cash requirement if you're making a profit. And this is on a monthly basis. Now let's go back here. If we change this to say, let's say we got $3 million, or let's say we got 2.5 million. Now it's saying, oh, it's still not enough. You need 700,000. And as you increase the financing, you're going to also get debt service. 3 million still not enough. Let's go to 3,250,000. That's about just right. So 3.2 million, you're at a surplus of 9.6, which means based on all these assumptions, you have enough. Now, interesting, if we put our sales count down, we're actually going to have a lesser cash requirement. Hold on. That's not enough, actually, because that low is actually the costs don't make sense. High. Oh. Well, depending on how you build the assumptions, like I had it when I was testing this when I originally built this part of the logic, is sometimes if you go from a high to base, your cash requirement would actually is say you have more cash with less sales, but that's just because maybe it might be the price of jewelry. It's 84. Oh, no, same thing. So it could be saying you have less or more of a cash requirement even if you're doing higher sales because of the cost of goods sold for the first 3 months of business might be higher, in the sales you are getting from those higher amounts are not covering the cost as well as if you didn't have to buy as much. So it just depends on the assumptions. Key is though that the math is right. All right, let's keep going. The next page is your returns, and this is going to show you leverage is negative because let's put this back to say 0. Now the return should be the same, and they all are the exact same, leverage and non-leveraged. So here's your internal rate of return. It's just taking the cash out and then the cash in, not including any kind of sale to business at the end of year 5. It's just saying whatever you put out in to start the business, the cash requirement, and then what cash flows the business itself generates over 5 years. So 7%. Cash requirements to start 3202. That makes sense. It's the same number as this 3202. And the cash return. So this is what you're getting over the 5 years, what you're getting back, and that would change if you have financing going on. Obviously, if you're financing, your internal rate of return could be higher, but your cash flow is going to be lower, but your cash requirement is going to be lower. Total return on investment, so that's saying of your 3.2 million, you're actually getting back 3.7. So total return on investments 117%. Net profit would be, whatever 700,000 is of 3.2 million. Your annualized ROI is 23%, so that means you're getting back from this cash requirement of 3.2. You're getting 23% of it back per year on average. And then your annualized return on investment, saying you put in 3.2 million, you're making back the 749,000 a year, which is what this 23% represents. And then we just got the charts here to visually see, leveraged and non-leveraged, what's your cash requirement, the cash return, the annualized ROI. And then here's your percentages, your internal rate of return, total return on investment, and annualized return on investment. So let's say we do have some financing, put this back in here, let's say 2 million. Now you can see the numbers change. So, and look at the leveraged IRR is higher because you've got less cash requirement, but also you're not getting back as much cash. You see, you're only getting 470,000 a year. Here, you're getting to 750, but you have to put up 3.2 million instead of 1.7. And you got to find that either by investors or put out the money yourself. And you can see these all changed. So there's your return summary. Next, we have visuals. So first visual, cash flow versus accumulated cash. That's saying, right off the bat, this is the initial investment required in a leverage case. So it's actually showing the net cash position, which is a running balance, and then this is showing you actually your total cash requirement, and then your actual financing is included in that leverage cash flow. So those netted out equals that bar right there, which is your actual net cash flow for the month. And then as you go, the little blue ones you can barely see are the cash flows, and then this running balance is your cash balance based on those cash flows over time. So right at the beginning, you've got cash out, maybe some financing, starting in the hole still, and then slowly paying back. This is the non-leverage, so there's no big financing here. It's just you're starting down at 3 million, and then whatever your cash flows are, it determines your running cash position, and here's your break even. In about 4 years to break even in this scenario. Here it's a little bit less. You're breaking even right before November 2020. Here you're breaking even after February 2022. And no, I did the months break even on the other tab. Other visual, this is a nice one. I like the annual cost summary. You've actually got total debt service, one-time cost, franchise fee, if any, order fee, or other fees as a percentage of revenue, sales tax, total annual fixed cost, and total cost of goods sold. So you can see how, and I've tried to structure them the way they'll likely be greatest to smallest, so your cost of goods sold and fixed costs are probably always going to be higher than the sales tax, other fees, franchise fees. One-time costs, you might have some spikes there. and then total debt service. But again, I like the 3D look. I like how you can really see what is going on. Now, let's say we have a big one-time cost. So you see how there's not much there right now. If we go over to our fixed and other costs, let's say in February 2020, let's say we want to do an expansion, it's going to cost $250,000. Now we put that in, that's going to affect our visual here. And there it is, a little pop, not much. But you can see now February 2020's got a little bit more cost there. Also updated this. Same thing here. We've got annual gross profit by year, dollar amount, EBITDA dollar amount, margins, gross profit margin and profit margin, net profit margin, and then average sale amount per item. Let me go back and see how these are affected by that one-time cost. Interesting. Now what you'll really be looking for when you start changing around numbers is the valuation. This is pretty cool. If you discount the cash flows, this does assume some kind of a sale at the end of the 5th year based on EBITDA multiple or a revenue multiple, and whatever the multiple is. So if we do EBITDA, we're saying it's 3x EBITDA. Your EBITDA is 879, so the value you're getting is 2.6 million. Discounted back is 937,000, and then here's your net cash flow before debt, and then the discount on that cash flow. So basically, you got the things that are determining the discounted cash flow value are the net cash flow before debt service and the discount on that. But then you also have to have the terminal value, and depending on if you're going to do an EBITDA multiple or a revenue multiple, you need your annual revenues and EBITDA. So that is why those are all there. You can see there I just put the revenue. Let's say this is probably, half, 50% of your revenues. You get a value 4.2, which is discounted back to 1.5. And then your enterprise discounted cash flow value is just a discount of all those cash flows. So the cash flows operations, cash flow from the possible sale, and the sales based on revenue multiple. And then here's your discount for the cash flows. And then I also put here, this is a nice thing to see, is your cash requirement non-leveraged. So this is just, you're going to need, based on all the assumptions that have been put in, you have to have $3.4 million to start this thing. Now you can finance some of it. You can put it all up in cash, but that's your total investment you need. And that includes all the startup costs in 3 months worth. 3 months worth of inventory, all the startup costs, and then any other negative monthly cash flows if you're running at a deficit for X amount of months. So here's the value, here's the cost. Now say we discount it, say 10%. The value is now more than the cost. But those are two interesting numbers to look at. Next is our break-even analysis. So we got another cool chart here. I like this one. And this is just showing you your variable costs each year, which add up to 14%. And variable costs, while we're talking about it, are just, possibly a franchise fee. And this could also include any advertising fees that the franchisor charges. You've got other fees. This could be, I don't know, credit card processing, something that is only gonna change with the revenue change. Then you've got sales tax if applicable. So those three things basically will always change no matter what your revenue is. These will affect it. If they're not applicable, you just put 0, and then you can see back on the break even, your break even is just going to be what your fixed costs are. But putting those back to what they were, you can see our break even. So it's saying our fixed cost for 2018 is 4.3 million. This is our variable costs. So just to break even on the operations, we're not talking about startup costs or any of that, or financing. I don't think 632 is the lowest we go. Let me see what 632 is. No, those are one-time costs. Okay, so yeah, this is not including debt service. So it's saying you're gonna have this many costs, 4.3 million, but any revenue you get, 14% of it's going away. So just to make $0 profit on the business, you're gonna have to make $5 million, according to these assumptions, for that year, and so on each year. Then I've got also your break-even months. So this is saying, according to our assumptions, it's going to take 38 months to become positive cash flow if we're leveraged. And that's including paying the loan, debt service, and everything else. Non-leveraged, 53 months. And that makes sense because if you're non-leveraged, you had to put more cash up front, even though you're getting more cash because you're not paying debt service. It's still, this is saying it's taking longer to pay back, or to get back to square one, basically, or covering up all the startup costs of your assumptions. Alright, so we got that. Forgot a K into here. Next is the annual pro forma. So this is where we're getting all of that summary data that I just went through, and this is pulling right from the monthly and then doing subtotals where necessary. So the monthly is really where we're getting the numbers from revenue assumptions. You can see here the big formula to pull that number, and this is just doing, so here you can see you've got the jewelry category and you've got the individual types of jewelry, and these are unit sales. Now some really important revenue assumptions, we'll get back to that now. So let's just look at earrings, for example. We have earrings starting the first month. Let's say we don't want to start them until May of 18, and we're saying, let's say in year one we're actually only going to sell 15 a month. So now if we go back to earrings, it doesn't start until May, and it's only 15 a month. So that's what that is doing. That's what this column C allows you to do in column H through L each year. Now the percentages are just showing you what's at a low, mid, high. So if we go back here, these numbers are not subject to low, mid, high. This is your total. So if we go down to earrings, revenue is 1260. And you can see obviously it doesn't start until May. So 1260 is actually taking, if we do the math here real quick, is actually taking 40% of the 15 times, and the low amount is $300 an item. 18. Hold on, what did I do here? 300. Is it low or is it high? Let me check. That's low for earrings. Oh. No, that's right, times 15. C86. Oh, I see. What's our price is at low. So that's why 1800. So if I put that back to base, now we go in, you can see 1800 is here. Now that's what should be showing up here. Yep, it is 1800. That's right. Okay, good. Glad that makes sense. Or I'm glad that works. Change the coloring here. So, and that works all the way down. We've got all these different categories and price. And like I said, this could be for any retail business. It doesn't have to be just jewelry. You could have all these different categories for your business and then drill down a little bit further and then define all of their revenue logic. Now we have one more little wrinkle to this, and that's you can actually just turn on and off revenue. So let's look at, say, necklaces here. Let's say we don't want to see any necklace revenue. Turn it off. Now look, if we go to necklaces, well, hold on. Because these are not starting until 2019, but let me put it back to January of 18. So you can see how that works. So necklaces is off, so we go back to monthly, and there we go. We can see all the revenue, but not necklaces. Let's say we want to turn off sets too, so we go in here, where sets, turn off sets, and sets are now 0. So the functionality is really nice, and that's supposed to just make it easy for you to work on the assumptions. So you can turn off whatever you don't want. You could plan out when all the different streams are supposed to start and the pricing of each. And we've got notes in here, likely cubic zirconia, gold diamond, high carat diamond platinum. Next is your cost of goods sold. So this has got, again, it's a mirror image of the revenue assumptions, but now you're just defining how much the cost is, average cost of your low, mid, and high. And that's where you're going to figure out what your gross margin is on all these different product categories. And obviously you're going to have to research this and then put the numbers in, but this is where you put them in. So it's saying, you know, we're saying we could sell this earring for $300 and it's going to cost us $120 on the low side. And I just put them all at 60% margin. They might not be that. It's just whatever you end up finding out in your own research. You can put it in here and see what the numbers look like. So that's cost of goods sold. Fixed costs, same deal. Here's your monthly cost by year. So this is saying, you know, executive salary 1 starts January 18, and that could change any month in the whole 5 years. And they're making $4,000 a month in year 1, $4,250 a month in year 2, etc. And that's how that logic works, and we've got that many running costs. And these are running costs, meaning whenever you start them, they just keep going every month. But you don't have to start them all at the beginning. You could ramp that up as well. Then we've got variable costs. We've already been over that, and we've got one-time project costs. One-time project costs, we kind of went over that, is you pick a month, and let's say you just have different things you want to do. It's like startup costs, but they happen later in the business after the startup has gone. So there's your functionality on that, and it'll just be a one-time thing that pops into whatever month you put in here. Then we've got the startup costs. We've been over this a little bit. You just enter all your startup costs, you know, showroom equipment, building if applicable, properties. And obviously if you're going to rent, then you're not going to have to pay for the building and construction. You might have repairs and maintenance times that happen, or you could just define repair and maintenance every month if you want to do it that way. But again, you wouldn't have rent if you got a building, if you're buying a building, but you might have rent if you're not buying it. Or you could have some hybrid. Key is that you're able to account for all of the different scenarios with these assumptions. And if you haven't found out by now, everything in this model that has a light yellow shade with blue text is what you can change and should be changing to fit your scenario. And then everything else, you can see like on the monthly, these are all formulas. So when you change on the assumptions, the model changes itself all the way through. Even if we go to the overview, these are all formulas, so these will all change. So the charts will change as well based on that. Startup costs. So that's, then we have a loan. So we put in the loan amount on the overview like I talked about at the beginning of the video, but then you also have your loan term, the annual interest rate of the loan, payments per year, and the date that starts. So that might not start January, it could start, say, in April. Starts in April. You could look at our monthly. You now see that cash from that starts in April. There's some of the revenue not starting until April as well. Right, I did all these in April. Okay, so anyway, put your April financing, so your cash, debt service, and stuff starts at that time. And then here's your cash flows. Let's see how that affects the overview. 1.1 million makes sense. Let's see here. I'm just looking. Where's our inventory? Got it. So that the reason why you don't see this as your cash requirement is because we're already taking into account these negative numbers within this starting inventory. So the 232,000 here is greater than these negative cash flows of 221 by 10,000. So your actual cash requirement is 1.2 million after financing. Let's see what else. Anything else? I think not. Oh, this is important. So you can put in 1 or 2 here. So if you press the little 1 button, it minimizes everything. So now you can kind of see a high-level view of everything. So here's your monthly sales. Oops. Monthly sales. Your revenues by low, mid, and high tier. Total revenue, cost of goods sold, low, mid, and high. Your total cost of goods sold, gross profit, other costs, monthly fixed, EBITDA, one-time costs, and debt service. So it's a little bit easier to see everything that way, but you can also drill down and see every single thing that's making up everything and make sure the assumptions are working like you want them. Same thing on the annual. Press the 1, rolls everything up in a bit easier way to view. So that's definitely useful and good to know. And I think that covers, I don't think there's anything else I need to cover. That's every tab. That's how the whole thing works. And like I said, you can do this for retail plus, I mean for jewelry, but it would be good for a lot of different retail businesses. And the formatting and structure is really dynamic, and I think this is probably one of the best models I've ever built. I'm gonna just say it probably is. It will be an upper tier, so the one time I only charge a one-time cost. Right now, my upper tier pricing is just $125. You send that to me. I'll send you the spreadsheet, and you can do that by going onto the link below. I have the smarthelping.com. I'll link right to the product page for this financial model because I build pages for each model, and then you can see the pricing will be there. And once I get the payment, I send you the spreadsheet. Alright, I guess that covers it. I'll see you guys on the next one.